What's up, everyone? It's Karthik with MoneyVest, and welcome to our Market Open live stream. And I'm gonna try to do these more often, just because they were a lot of fun. It keeps the community very engaged, and I can answer a lot of questions in real time for all of you, and also analyze a lot of stocks for you guys in real time. So let's get started. I'm very excited. This is a Fed week, so we do have the FOMC meeting on Wednesday, March 19th. So in just about a couple days, we've got Jerome Powell's speech as well as the summary of economic projections that's also going to be released. So there's a lot of really important data that's coming out for the market. And I posted a video earlier today going over the understanding of the overall trend and the pattern for the market that we're currently in. So the entire market structure, because I really don't want anyone to make predictions or trade on predictions, but instead understand where we are and where we're potentially headed, as well as understanding the risk and reward as well. So looking at the markets right now, QQQs are very flat. We got S&P 500 also very, very flat right now. We've got Tesla here down about 1.3%, so down about trading under $247. Nvidia was up. Actually, it was down a little bit earlier, and it's now pushed back up over 1% higher, back up to over 123. And even Palantir getting a nice little burst here, up over 3%, as Palantir continues to be one of the oversold stocks here. Valuation is still pretty expensive in my view, but we are back up to almost $89, up almost 3%, a little bit over 3% at the moment. So lots to discuss. Once again, thank you so much for joining, everyone. I really appreciate it. I'm going to try to analyze and answer as many questions as possible, and of course go over a lot of different stocks here for all of you guys. But let's see. So we got Ian first for joining. Thank you so much. Robinson, live stream, we back. Yes, we're back for now. And I really want to come out here and thank each and every one of you for subscribing. If you haven't already subscribed to the channel, but we just crossed over 97,000. So I really appreciate all of you. So thank you so much. And we are very close, very close. We're about 1 month away from hitting our target of 100,000. That would be just so special. And I will be doing a lot of lives, during that time. So please share this with other traders, investors that can benefit from the value of the content that we're providing together as a community. And also subscribe to the channel if you haven't already, because this has been a blessing. We've been at it for the last 5 years. It's been a long time coming, and I might cry. I might actually cry the day we hit 100,000, because it's just going to be really emotional, for us, for all of us. It's not just my achievement, but for an entire community's achievement of getting to this level. And especially for our Discord, when you have so many members from a couple of years ago, 3 years ago, 4 years ago, we have all grown together, and it's just going to be absolutely awesome. We're going to have a nice party, we're going to have a longer live stream, and we're going to celebrate together. It's only a matter of time. So it's not a question of if, it's a question of when. And yes, I might have a drink on live stream as well once we cross over that milestone. So subscribe, share it with other traders and investors. But let's get right back into it. So, Fed meeting coming out later this week, and volatility here continues to be a little bit more elevated. And, I wanted to also go over the market breadth analysis, which I shared earlier. So let me just pull up that spreadsheet here and see if I can go over that market breadth analysis right about there. This was the chart that I was sharing in my previous update, it's very important to understand where we are in terms of these thresholds, because it helps you get a bird's eye view of the entire market. And so what was interesting during this analysis is that once we break below the 200 simple moving average, right? Once majority of stocks are trading below their 200 simple moving average, we actually tend to stay there for much longer than if we are trading below our shorter term moving averages. For example, the 20 or the 50-day moving average, right? So for example, the number of days spent below the 20-day moving average for majority of the stocks is only 2 or 3, right, on median and average basis. For 50 moving average, it is 4 and 6, right? So these are some really, really low numbers, meaning that we are only there for a couple of days before the markets get a technical rebound. But that is only short-lived because of the fact that there are shorter moving averages, 20 and 50. They are more prone and more susceptible to market bounces. So as soon as we get a 4 or 5% rally, we're back above that 20-day moving average or back above that 50-day moving average. But when the sell-off actually accelerates further and it gets actually much worse, and it breaks below the 200 moving average, which is a longer moving average, then we actually tend to stay below those moving averages for a much longer time frame. We're talking well over 50 days, as opposed to the shorter time frames here of 2 to 3 days or 4 to 6 days. So that just speaks volumes to once these market breadth here starts to break below certain levels, things actually take a turn for the worse, and things get much worse before they get any better during these sell-offs. And so for keeping that in mind, I think it's really important for us to recognize that there is no rush in buying or dollar cost averaging, right? There's going to be opportunities, and we have to just be patient and allow for the prices to come to us, especially when you consider where volatility is, where the markets are as a whole. We talked about S&P 500, in this lower high and lower low pattern where, yes, we can get a nice little bounce. Yes, technically on a short-term basis, there's opportunity for us to, maybe get up to this resistance of 5,700. But we also have to recognize the fact that we're still well within the context of a potential downtrend of lower highs and lower lows. And that's what we have to recognize from a change in trend perspective, because the markets don't just keep going up and down in a straight line. They actually make trends, meaning they go, lower highs and lower lows. And on the upside, they actually make higher highs and higher lows. And so oftentimes what happens is when people look at the lower highs and lower lows, they make the wrong assumption here, that, the bottom's in and we're back up to all-time highs. The bottom's in, we're back up to all-time highs. And then eventually what happens? We sell off further. So it's really just an understanding of the overall market structure as opposed to isolating these moves and looking at them independently, because that can give you the wrong signal. Whereas looking at the overall trend is much better. It's telling you the entire market structure. But, okay, Megalift says 100,000 subscribers and Karthik buys us all a beer, so click the button. Yes, 100,000. Man, that's going to be crazy because buying everybody a beer, that's going to run me almost $500,000. Mike says, you're so close, Karthik. Yes, very, very close. When will you IPO? Drinking Karthik on live stream is so good. Is good time all. Subscribe. Don't get drunk on live stream if you have a drink. Yeah, no, I'm just going to have a small drink and that's about it. I'm with MoneyVest since February of 2020. Vault says the best information is here. No question about it. Thank you so much. I really appreciate that, Vault. And our focus has always been to provide very data-driven, very numbers-driven, specific analysis based on historical data, while also having a very balanced approach to not being overly optimistic all the time, but also not being overly pessimistic, but just trading the markets, investing in the markets as we can see them right now. And I think that creates a little bit more objectivity in our analysis, and it doesn't blindside us with one worldview, because this is something that I learned in the book Psychology of Money, right? From Morgan Housel. He talks about Warren Buffett and how the reasons for why Warren Buffett was able to last this long, right? Because longevity is a true secret to his great wealth building over many, many years, over many decades, in fact, longevity and survival. And he talks about that he did not fixate himself to one worldview where markets are only going to go up or markets are only going to go down, a crash is impending, or everything's going to recover always, right? Because there's this big saying that stocks only go up. Yes, while that has been true in our recent history, that's not always the case. And so we have to be very objective in our way of thinking that as long as there is market leadership, as long as there is innovation, as long as there is technological advancement, as long as there's pricing power, as long as there's capital inflow into equity markets, especially the US markets, all of that's going to happen if there's earnings growth. If there's no earnings growth, if there is no economic growth, then there's better opportunities for investors to take their money with. And money is going to go where opportunity is. And so if there's no opportunity, there's not going to be any money coming in. So that's why we have to keep in mind that just because it's worked in the past doesn't mean it's going to work in the future. So That is very important, right? With any market or any investment opportunity that you're looking at. A lot of, and again, take it a step further, and this is what I think about, a lot of the times is that, people say that real estate always goes up, real estate prices always go up, and you can never go wrong investing in real estate. But if you really think about it, it is nothing but a, just a, at the end of the goal is the demand and supply, right? If the demand continues to increase, which is what we have seen, the population increase, and supply is the number of units or the scarcity of the land, right, that we have. But there's a very strong forecast that in the next 50 years, the population is already starting to decline. And if it starts to really decline, if population starts to decelerate and starts going down, then that long-standing belief that real estate prices keep going up may not be something that we live to, in the future. If population starts declining and there's no longer demand, and there is an abundance of supply, and so prices will start coming down. And so people could be living in a new world of real estate in 2100 or 2150, so to speak. So it is, things are changing, things are evolving, everything is temporary, in my opinion, and I think that's what we have to live with. That's what we have to analyze on an everyday basis. So, okay, enough of that. Let's go into some of the questions. Johnny, I'm from Texas. I need to take a shot for me. Matt says, Caddy, what do you think about JEPQ ETF, covered call ETF? So I think a lot of these, equity premium ETFs are good. They're certainly, worth looking into. And, for example, this one has been pushing higher, just because of the NASDAQ 100 or NASDAQ composite, has been pushing up consistently. So it's done really well. And of course, it's sold off a little bit, from its highs. However, there's going to be fees attached to these kind of ETFs, right? And so while they are giving you a nice 10.75%, net of inflation and net of fees, you might be a little bit lower, closer to what you could actually do for yourself if you're trading the wheel strategy and if you're running a strategy which is NASDAQ specific equity premiums that you're generating. Because it's not difficult, to be honest, to generate 10 to 11% per year trading NASDAQ, covered calls and cash secured puts with a really low delta. It's not that difficult. You can actually achieve 8 to 10% on average per year by trading options or running the wheel strategy on the market indices, S&P and NASDAQ. But it is really getting up to that, 11, 12, 13, 14% range is when you're kind of pushing up the risk curve and going higher on the deltas. So, you could go by like 15 delta, 18 delta, and you can still do like 10.5 or 11%. But the moment you get up to, let's say, 30 delta or 40 delta, now your return is going to be closer to 20%, 22%, but then your assignment risk is also much higher. So there's always that trade-off for risk and reward. And that's what we are here to evaluate. I did a video earlier on the real estate channel on opportunity cost, because every one of us has a finite capital amount. In other words, we don't have unlimited cash. We all have a finite number of money available to us to invest. And so every investment that we analyze has to be done on a very relative basis. Stock A versus stock B, investment A versus investment B, because there's a lot of alternatives out there. And in the markets, everything is an opportunity cost, right? Everybody is fighting for our capital. Every asset class is fighting for our capital. So we have to invest where we find maximum opportunity. Otherwise, there's just no point of investing at all. Nobody would invest, in any investment that gives you 2% rate of return, where you can do 4% in a government bond, right? On a very risk-free basis. So, that's why it is very important to have a relative analysis of a lot of these investment opportunities and asset classes. But anyway, so markets are open now. So we're seeing Tesla here sell off right at the open, down about 3%, back down to $242. We got QQQs essentially flat. S&P 500 also very, very flat here. We got the Palantir stock up over 1.4 and coming over to NVIDIA, which is also selling off right at the open here, up over 0.5% still. Coming over to SPX, so this is where we are. Starting to see a little bit of that momentum coming in as volatility here gets crushed on Friday, and right now we're essentially flat, just a little bit under 22 right now. Okay, Walt says, and believe me, I've been working from home since March 2020, so I actually had quite a lot of time to watch the market videos in background while doing my job, and MoneyVest is one of the best channels. Thank you so much, Walt. I really appreciate that. Pure fundamental first, then technicals to help make decisions. Purely data-driven, no opinions, because I think this and this will happen, so no predictions. So, yep, thank you so much. I appreciate that, and I think it takes time. And I was watching a 1-hour video of Howard Marks going over a lot of his memos. Actually, I'm going to bring it up. I'm going to share this with everybody, which I think is going to really be very educational. I think it's going to be one of the most educational videos that you're ever going to see on investing. So I'm going to share that. It's a 1-hour video where Howard Marks is actually giving his 78 years of his understanding of the markets in just an hour. So this is the video that I highly recommend everyone to watch. I'm going to put the link, in the chat if you're interested, but 70 years of investing wisdom in 60 minutes. This is Howard Marks. Anyone can become rich with stocks is what he says on the thumbnail, of course, but check it out. It's very, very enlightening. It opens your perspective to new ideas, new strategies, new ways of thinking about money and markets and risk and reward. And it's very, very enlightening. And Howard Marks is kind of like the king of risk-adjusted outperformance, right? Very much a focus on risk, and of what he specializes in is in defense investing, is like avoidance of market losses, and the winners will take care of themselves. Where a lot of the focus, especially on mass media and some of the people that are coming on CNBC, a lot of the focus is on the next best stock, is on the next best investment, is on how we can generate more return. But Howard Marks' main focus has always been how can we avoid losers. Very different way of thinking. It's not what's the next best stock. It is what is the next best loser that I need to avoid. So different way of thinking, and it's been very, very good. So yeah, definitely check it out if you have the time. Okay, so if you have any questions specific to any companies, let me know, and I'm more than happy to go over those. But markets right now seems to be popping right back up. Got QQQs up over 25 basis points. Got S&P 500 up over 26 basis points. But let's just dive right in for some individual stocks right now. So coming over to Apple first, incredibly oversold. So a little bit of a technical rebound is in the cards. However, resistance around 214 and 219 for Apple. There's been a lot of speculation that Apple kind of dropped the ball on Apple Intelligence, and it's really behind the wheel. In other words, it's not able to compete on AI for a lot of these smartphones and everything that's coming out in terms of technology. But Dan Ives continues to remain bullish. There's a lot of bullish commentary that Apple's main business services is going to really take off, and that's where a lot of that margin expansion is coming from. But resistance right now is going to stay put at 215 and 219. But I do still believe that I think Apple's valuation is still expensive for a company that's really slowing down on its growth, right? Because if growth is slowing down, then I don't think that Apple deserves such a high multiple of valuation that it's trading at. So I think it can really see that multiple compress if growth starts to stall a little bit. And Apple is trading at the same level as it was back in June of 24. So it's going to be almost 12 months of no performance from Apple. Okay, poor Tesla. Yes, Tesla's been selling off quite a bit. It's been cut in half from its all-time highs. So, if you come over to our MoneyVest platform, and I'm going to wait for this to load up. So again, 2.75 is where we're at. And if you go over to the market snapshot, this is the entire snapshot for the market, where a lot of these companies are trading in a correction or a bear market, or worse, in a full-blown crash like Tesla. It's down over 50% from its all-time highs. And then, of course, we got all these other companies like Apple, Amazon, Meta, Microsoft, Nvidia, and Google, just all over the place. But for the most part, selling off. So Tesla here, we've got a support, I believe, at around 220s, 230s. So this is the area of demand inside this green rectangle that we're watching. And even today, it's validating that $238, $240 level. Resistance right now is going to stay up at a 273, 275. So yes, it's been really, really weak in terms of its overall selling pressure, but even the move higher was not built on any fundamentals, right? So this entire 100% rally was purely political, was purely sentimental, was purely momentum. And so it's no surprise that we've kind of given up on all those gains once the momentum, the sentiment has died off. So if this was a fundamental move, then things can actually sustain those levels for longer. For example, NVIDIA went up purely on fundamental reasons and of course momentum. But once it went up, it didn't really see a crash all the way down to like 30, 40 bucks. Instead, it kind of stayed up there. Why? Because once you see a fundamental driven move, yes, there's a little bit of repricing that happens in terms of valuation because we overextend to the upside and we need to kind of reset and rebalance. But Tesla went purely on political influence, right? There was no fundamental reason for Tesla to more than double in 3 weeks, 4 weeks. And so it's very normal for us to see this, after reaction of the stock getting cut in half now, practically back at the same level as it was prior to this move. And again, before that, it was actually trading on fundamentals. And so we're back to normal. We're back to kind of reality for Tesla. I know it's kind of a hard pill to swallow for investors because if you didn't take profits here and you kind of waited all the way down to these levels, you're kind of thinking to yourself like, oh man, I more than doubled my investment and now I haven't taken any profits. Then that's more of a trader mentality than it is a long-term mindset, right? So if you still believe in the company long-term with everything that they're doing with physical AI, nothing really changes other than the volatility that we're very accustomed to seeing as long-term investors. But of course, as traders, you have to have your stop losses, you have to have your profit targets, you need to know where to take profit, where to exit versus where to stay out of it. So that's how Tesla's been. It's an incredibly volatile stock. It's something that I think most long-term investors are accustomed to seeing. But yes, markets are flying right now. Advanced Micro Devices, let's take a quick look on AMD, or I should say Advanced Money Destroyer, up 3.6, 3.5%, so very nice move to the upside. $106 is going to be that level right now that we're watching. That's going to be that resistance, that area of target to watch for AMD. And then beyond that, we're going to be watching 110 to 116 for this stock here, still within the context of a downtrend. So again, learning about market structure, understanding how the charts are, what the trend is very important because that's really going to help you make better decisions. So, as I said before, technical analysis is not a tool to predict markets, but it is a tool to make better decisions. And it is a tool that works very much on probabilities and to make more objective, more holistic decisions about your stocks that you're trading or investing in. So that's why I think it's really important for everyone to have at least some baseline understanding of charts and trends and patterns and technicals so that you can at least read the chart well. For Novo Nordisk, the support level is going to be right about here at 74.75. So we actually had that over here on this chart, I think, where it's trading at a very strong support here. It's been selling off quite a bit, ever since the news from the progress on their different drugs and medicines that they're working on. But this right here is a massive gap that Novo Nordisk kind of left out. And we also have a little bit of a breakdown from this bear flag formation. So you could argue that this was the pull, a little bit of a bear flag, and then of course another breakdown for Novo Nordisk. So we're at a support. This is a level that we have seen from before, from back in May 2023. And that's exactly where we're trading at the moment. So I have it on my shopping list. We had to remove it because of ADR issues, because it's an ADR and it's not on our MoneyVest platform right now, but it is still in my shopping list with my buy targets already mentioned on Discord in the spreadsheet. Okay. So Ken, how can I set up a meeting with you to show you an indicator I've developed? I'm a huge fan and think you'd really find this valuable. That's actually very, very good. You can email me. Definitely email me and we can set it up. I'd be more than happy to look into what that indicator is. We can backtest it and see, what kind of results we can get and if it's a huge addition to the community. So you can email me at admin@moneyvest.com and I'm more than happy to, set up a call with you. Okay, let's take a look at HIMS. So HIMS. So let's take a look at that one. So, it's interesting, right? Because, we developed the MoneyVest Index with a lot of backtesting, with a lot of really good results that we were able to get. So this is the MoneyVest Index that we've included for all the members on our MoneyVest platform. And, if you come over to Strategy Tester, you'll notice that we actually got some very good results, right? So 99.19% was the profitable trades after 124 trades. And this is, again, the list of all the trades that were back tested in this deep testing that we did. And so this is the kind of work that I think is important. Again, nothing's going to be perfect. Nothing's going to have this crystal ball, or nothing's going to be that secret. Everything has to come with a little bit of margin of safety, because anything can fail and everything will fail eventually. So that's why we have to be very careful when looking at these indicators and these different signals out there, because at the end of the day, it's really just intuition. A lot of that intuition also plays a big role. Okay, let's take a look. AMD is moving. Yep, memo style videos from Howard Marks. I fully agree. I think those are some very, very good nuggets of information, super educational as well. Is it Toast a good value right now? Ticker symbol TOST. Let me take a look for Johnny here. TOST. And I haven't looked at this company. Like, what do they do? I have no idea. I may have analyzed it at some point, but looks like they're a packaged software company. If I scroll down a little bit further, very good revenue growth. Oh, by the way, I forgot that I'm actually working on a investing checklist. So this right here is going to be the MoneyVest individual stock investing checklist. It's going to have 10 points that we need to look at, right? We need to analyze when investing in individual stocks. And it's gonna vary from understanding the competitive advantage to understanding the total addressable market, to financials, to management, to earnings, profitability, margins, operating leverage. All of that is going to be included in this checklist. And I think this is going to be very important and valuable, especially for new beginner investors as well. It gives you a bit of a framework to work in and look at a lot of these companies that you're analyzing, whether they fit this framework. There might be other factors at play, but I'm going to try to really simplify this to the best of my ability to bring you the 10 most important that I feel to be points that every investor needs to analyze for individual stocks when you're looking at them as candidates for long-term investments. So this is going to be available for free. Actually, this is going to be available for all Patreon members for free, no charge. All I'm asking in return is that you subscribe. That's it. I'm going to do a video on this, and all I'm going to ask is that you subscribe so that we can get to our target. But, okay, Toast does food orders for restaurants, okay? So very similar to, I feel like, Uber Eats or some of those players. Engages in development, provisions of consumer payment application for restaurants, offers terminals, kiosk, guest-facing display, and system accessories, point of sale, reporting analytics, online ordering, all that stuff, okay? For a lot of these, it really is, it becomes a question of having a moat, right? What is really truly the moat here? What sets them apart from everything else that is out there? Because you can see some good revenue growth and some good earnings in the beginning if you have, let's say, a first mover advantage. But if competition starts breaching that market, if there's a lot of penetration from other players, and if you don't have a defensible moat, then the business is toast. No pun intended. Because if there is no defensible or impenetrable moat there, then you're very vulnerable to competition. And moat can come in various different forms. It could be, cheaper product, better technology, faster delivery, higher switching cost, no other alternative because it's the best technology, best software. It can come in a lot of different, best brand name, best recipe, whatever. It can come in a lot of different forms. And so for Toast, with my limited fundamental analysis right now, just going to be purely going off of technicals right now. So keep a close eye at this support right here at $32. Resistance all the way up here at $44. And if we take a look at the fundamentals right now, we've got valuation just under 4 times sales and a little bit over 54 times cash flow. And if you come over to earnings estimates, we've got some decent estimates for earnings growth, 77 cents to $1.16 to $1.47. So that is good, and revenue expected to grow from just under $5 billion to over 8.6, just over $9 billion over the long term. So Not bad. If you take a look at balance sheet very quickly, we've got some negative net debt here. So negative $1.38 billion of net debt. So that's also pretty solid. We're always looking for companies that have good balance sheets with more cash than debt on the balance sheet. And that's also going to be one of the things that we look at when we're looking at the investing checklist. It's going to be one of the points to look at the balance sheet. And again, more cash and debt compared to debt on the balance sheet. So Nvidia starting to really roll over here. Now negative on the day, down about 0.5%, a little bit under $121. And we've got Tesla still down about 3%, but markets overall starting to push higher. So if you come over to Mag 7 specifically, it's only Tesla, Nvidia, Amazon that are selling off. Netflix getting a lot of outperformance here. We got Apple, Microsoft, Google just barely up. So I think a lot of that momentum is coming from other parts of the market. As discretionary is up 30 basis points, technology is up 0.5%, but look at that. Staples, industrials, energy, comm services, those are the sectors that are really moving on the day. So if you come over to market concentration, so far just a modest $146 billion. And top 10 are actually collectively down on a net basis, $21 billion. So a lot of that momentum is coming from other parts of the market. Netflix is up the most, $11 billion, followed by Oracle, $10 billion. Nvidia is $9 billion. AMD is $6.5 billion. In terms of percentage gain, Intel and Enphase are up the most right now. Yeah, we really are toast. If Enphase and Intel are up, yeah, we really are doomed. I made this joke earlier that, a day like when markets were selling off, Enphase was the only company pushing higher, and I was like, yeah, I think we're done here. If all the money is going to Enphase, we have really hit the peak of that fear in this market. Intel, also one of the companies, up 4.6%. So among all S&P 500, these are the two stocks pushing up the most. AMD is getting some nice momentum, up almost 4%. So Amray, thank you so much. Super valuable content as usual. Hope to see you reach 100K subs in Q1. Yes, that's going to be the goal, first quarter. That's what we want to get up to. To be honest, solar power is picking up momentum. Yes, so Enphase, again, needs to show that in the numbers. And if quarterly revenues, annual revenues continue to move in the right direction, Enphase has got a lot of potential upside, but that is, again, the big question, is if it's going to see that European penetration that's been long awaited, as well as in the US, if it's going to be able to attract more market share and more consumers for their end products, which are still, again, expensive to install. And the user doesn't see the benefit of solar panels until 7 or 8 years down the road. So marketing has to be very much on point for Enphase. And since it is a very technical product, it is difficult to market it to the end consumer, which is also what we discussed during the earnings call for Enphase. I briefly remember where it was becoming increasingly difficult to explain from third-party suppliers what Enphase does and why it's so important and why it's different from all the other competitors. Anyway, so that's going to be it for today, everyone. Again, thank you so much for joining. We're going to do more and more live streams, during market open hours to navigate this market, to answer questions, as many stocks I can analyze as possible. But right now, just to give you a bit of a recap, we are slightly green. This week we've got the Fed week, Wednesday, March 19. Stay tuned. I'm going to be live to cover all of that, the SEP, the statement, as well as the summary of economic projections. But for now, markets are very flat. Not a lot of action in the S&P 500 on NASDAQ here. We're so used to seeing 1% to 2% days that this feels like a very boring start. We're only up like 40 basis points. So, that's what volatility does to you. It makes every other day very normal. Unless, of course, we're seeing a 2 to 3% day. Everything else is just like, it's whatever. Nothing crazy. So thank you so much for joining, everyone. Make sure that you drop a like and subscribe. Don't forget, we just crossed over 97,000 subscribers. So thank you so much for being a part of our community. I appreciate you all. And let's get up to 100,000 within the next few weeks here. And so we can have a very nice party, despite the markets selling off. And maybe that's when I'll reintroduce you guys to the red mic. So thank you so much. Happy investing. I'll see you all